let's take it across to Unmesh, who's joining us from HDFC Securities. He's, of course, the head of Institutional Equities there, Unmesh Sharma, that is. Hi, Unmesh. Good to be speaking with you. Well, what do you make of the market setup right now? Come the RBI policy or the budget or even earnings for that matter, there's a clear sell-on rally which is at play here. Do you expect this kind of texture in the markets to continue, that we have made a bit of a peak already and it will be a lot more sideways and consolidation for the very immediate term?
Yeah, good afternoon, Anisha. So that's the $1 billion question, really. But look, we've had a very very stellar run latter half of last year. And it ended on a very positive note because the expectation that there will be some volatility related to politics is gone with the state government elections in December. What you would have noticed is that there was very frantic activity in December with FPIs who generally go quiet in that month, actually seeing some very heavy buying. Having said that, there are three risks which were there at the start of the year, which continue to remain there even now. Okay, well, I'll talk about the positives later, but I'll tell you what the key risks are. One was the fact that usually a lot of the positivity around elections comes through only after the election results are out or just before that. This time, I think the market has priced in a large part of the positives, assuming that the election results are already in. So that's one. The second is that if you look at the Indian macro within a global context, I would say that while we are quite standout, especially as an option to China, but also because of the strong macro here as well as twin balance sheet, there is no major issues. But at the same point in time, there is a lot of uncertainty. And one big change which has happened in the last month is the fact that there was a large expectation that the rate cut cycle in the US in the bond market was what was priced in was that there would be a cut starting in March. But now, with the incremental commentary and the data on the inflation, that's got pushed out to June. Now, the Indian RBI policy has not changed anything. But at the same point in time, in the global, if you look at it from that context, there is a change in view, which we had expected, but at the same point in time. And then the third is that the market's 21 times FY25. Now, what that tends to do is, accentuate all these moves. So on a very small change in earnings expectations, given where the PE earnings, PE as well as EV/EBITDA multiples are, you see exaggerated movements in stock price, which is exactly what has happened. So that's kind of spooked the market.
Yeah, exaggerated moves both on the upside and the downside. But I wanted your view, Unmesh, regarding the private banking space and banks as a whole, to be honest. They have been underperforming for the longest time. There isn't a big challenge when it comes to the earnings or valuations as such. What then explains the underperformance?
Yeah, so there are two things. One is that the private banking space historically has been dominated by the FPIs just because of the sheer float which is available. So anyone who takes a macro call on India needs large liquid names to participate in. So there has been a technical matter of the fact that with FPI, kind of, with the exception of that short period in November, December, and maybe even early January, if you look at it, there has been selling, so they'll sell what they have, right? So there's a bit of that. The second is, I think that while some banks have done better than others, I think the story that at some point in time the rates cycle will catch up and the NIMs will start to peak out and maybe even compress at the margin has started to play out. And this time around, I think the big issue which has been seen has been around the deposits, because I think what has started to happen is that at the macro level across private banks, the view is that if the deposit growth is not outpacing the asset growth, then at some point in time, the runway for delivery of consistent growth kind of goes down. So in that context, I do believe that it's gone a little bit too far on the large private banks, which is why in our model portfolio as well, we have ICICI, also even SBI for that matter, not just private, but also SBI. I think the large banks, I think, may have gone a little bit too far, but at the same point in time, that's what's impacting them in the short term.
Sure, okay, so still, positive on at least select banks, ICICI, SBI, that. But I also wanted to get a sense regarding the public sector entities as a whole, whether defense, railways, power, power financiers, name any of those baskets, they have seen a very, very sharp up move. And even OMCs for that matter, shouldn't forget that. Would you, venture out and still recommend a buy on some of these public sector entities, or it's a case of clear bubble and over exuberance now?
No, no, we are not in bubble zone for sure in the markets. I think exuberance, yes, I feel so, especially in the mid and small cap. I think there has been a theme which has played out, which is that you should buy the laggards. This is very typical of, very close to the peak of the bull market kind of themes which play out. Also, the nature of the money has changed. So if you look at, a lot of the historical analysis that we do in India on what happened in flows in various parts of the cycle is a little bit different this time because a very large flow is coming in from the domestic investors. And the themes that we are seeing playing out there is one, buy laggards, buy stocks which have momentum. So, some of the moves get over exaggerated. Now, one is that the way we look at PSUs is that we split them between the banks and the non-banks because they have very different drivers. On the banks, one of our largest overweights is SBI. We believe that in a model portfolio which is generally multi-cap, we believe there's no real reason to go beyond the large caps like SBI or Bob down the chain, so as to speak. So which is why you will see that we are generally there, and you capture most of the upside there as well without having to take the full volatility risk, and which is why I think we are comfortable. If you look at other sectors, we believe that on the PSUs we are quite selective. OMCs we have been positive, though our analyst Harshad has recently downgraded IOC and HPCL because of the sharp run up in valuations. Needless to say, that could go up a little bit more. I think there were two reasons for that. One is that I think crack spreads on especially autos, for example, was in the mid 20s. Honestly, I used to cover oil a long time ago myself, and I don't remember these numbers being in double digits. But so this is quite stellar. Can that continue? The answer is at some point in time it has to cool off, and that's actually what has started to happen. So on the OMCs, maybe there's a little bit of juice left in the trade, but we believe this is the last leg of the rally on that front. We do like those names, but at this point in time, we would advise caution.
Okay, so
What
still
we
there
do
are.
like in the PSU is the gas utilities. Yeah.
No, fair enough. So still there is some room available on the upside, at least on OMCs and other select pockets. Thanks, Unmesh, for joining us today. Appreciate you making time and speaking with us.